The silver market is experiencing something that hasn't happened in over 40 years, and most Americans have no idea it's coming. Right now, as you read these words, silver is trading above $60 per ounce, a price level that seemed impossible just 2 years ago when the metal languished in the 20s. But here's what makes this moment truly extraordinary. This isn't just another commodity rally driven by speculation or temporary shortages. What's unfolding in the silver market represents a fundamental restructuring of how the global financial system treats precious metals, combined with supply constraints so severe that some of the world's largest banks are scrambling to find physical metal they promised to deliver. Let me take you back to understand how we got here. In the aftermath of the 2008 financial crisis, global banking regulators realized that the existing rules had failed catastrophically. Banks had been allowed to maintain dangerously over-leveraged positions, and when the system collapsed, taxpayers around the world footed a multi-trillion-dollar bailout bill. The Basel Committee on Banking Supervision, an international body of central bankers, spent years crafting new regulations designed to prevent another meltdown. These rules, collectively known as Basel III, fundamentally changed how banks must account for the assets on their balance sheets. For precious metals, Basel III created what financial historians will likely view as the most significant regulatory shift since President Nixon closed the gold window in 1971. Under the new framework, physical allocated gold and silver received classification as Tier 1 assets, placing them in the same category as cash and government bonds with 0% risk weighting. This represented a dramatic upgrade from their previous status. But here's where it gets interesting. The regulations simultaneously imposed an 85% required stable funding ratio on unallocated precious metals positions, the paper contracts that have dominated modern bullion banking for decades. What this means in plain English is that banks must now hold stable funding equal to 85% of the value of any paper silver positions on their books. This single rule change makes it prohibitively expensive for major banks to maintain the massive unallocated positions that the entire precious metals trading system was built upon. The European Union implemented full Basel III compliance in January of 2025. The United States rolled out its version on July 1st of 2025. But here's the critical piece that creates immediate pressure. The United Kingdom, home to the London Bullion Market Association, which handles over 200 million troy ounces of silver daily worth approximately $3 billion, delayed implementation until January of 2027. This staggered timeline creates a perfect storm where banks globally are unwinding decades of paper-silver positions right now, even as London continues operating under the old rules for another year. The tension between these two systems is already showing up in extraordinary ways. To understand why this matters so profoundly, you need to understand how modern precious metals markets actually function, because they bear little resemblance to what most people imagine. When you think of someone buying silver, you probably picture them walking out of a dealer with coins or bars in hand. But the vast majority of silver trading happens on paper. According to testimony given at CFTC hearings, the precious metals market operates on a leverage ratio of approximately 100 to 1 for gold. For silver, industry sources suggest the ratio stands even higher at 300 to 1. Think about what that means. For every single ounce of physical silver that actually exists and is available, there are 300 ounces worth of paper contracts claiming ownership or future delivery rights. This fractional reserve system allowed bullion banks to profit enormously for decades. They could maintain small inventories of physical metal while trading vastly larger quantities on paper, confident that only a tiny percentage of contract holders would ever demand physical delivery. The banks earned the spread between lending rates and borrowing rates on these positions. Much like traditional banks, profit from the difference between what they pay depositors and what they charge borrowers. It was a beautiful system for the banks, generating billions in profits with relatively little capital tied up in actual metal. Basel III dynamically undermines this entire business model. By requiring banks to secure stable funding equal to 85% of unallocated positions, the regulations eliminate the capital efficiency that made paper precious metals trading profitable in the first place. The consequences are already visible, and they're dramatic. Silver lease rates, which measure the cost to borrow physical silver, typically hover around 1 to 2%. In the first half of 2024, these rates spiked to 7%. By September of 2025, silver lease rates reached unusual negative territory around negative 1.2%, meaning that borrowers were actually being paid to take silver. When you see lease rates go negative, it's screaming that there's a severe shortage of immediately deliverable metal. The physical silver exists somewhere in the world, but it's not where it needs to be, in the form it needs to be in, or available from owners willing to lend it at reasonable rates. Now layer on top of these regulatory changes a supply situation that can only be described as dire. The silver market has experienced 5 consecutive years of structural supply deficits through 2024. The deficit in 2024 alone stood at approximately 149 million ounces, with total demand of 1.16 billion ounces outstripping supply. Over the 5-year period, cumulative deficits total somewhere between 678 and 800 million ounces. To put that in perspective, that's equivalent to 10 months of global mining supply. This isn't a temporary shortage caused by a mine closure or a strike. This is a fundamental mismatch between how much silver the world is using and how much is being pulled from the ground. Here's where the supply story gets really interesting, because silver is unlike almost any other commodity. Global silver mine production in 2024 reached 819.7 million ounces. But here's the thing. Approximately 75% of silver production comes as a byproduct of other mining operations, primarily copper, lead, zinc, and gold mines. The miners aren't digging specifically for silver in most cases. They're mining copper and getting silver as a bonus in the ore. This creates a bizarre situation where even if silver prices double or triple, production can't respond the way it would for a primary commodity. If you're a copper miner and copper prices are low, you're not going to ramp up production just because silver prices are high. The economics of your operation are driven by copper, and silver is just extra revenue on the side. This means silver supply is remarkably inelastic, unable to quickly respond to price signals. Mexico leads the world in silver production at 5,000 tons annually, representing 20% of global output. China, Peru, Bolivia, and Chile round out the top 5. But several major producing countries reported declining output in 2024, with Chile's production falling by nearly 9 million ounces year over year. Meanwhile, secondary supply from recycling increased 6% in 2024 to reach a 12-year high of 194 million ounces, but this represents less than 20% of total supply. Recycling faces its own constraints because the concentration of silver in many electronic products is so minimal that it costs more to recover the silver than the recovered metal is worth. While supply struggles, demand is exploding in ways that would have seemed impossible a generation ago. Industrial demand reached 680.5 million ounces in 2024, the 4th consecutive record year. To understand where this demand is coming from, you need to understand what makes silver unique among all the elements. Silver is the most electrically and thermally conductive element on the periodic table. Nothing conducts electricity better than silver. Nothing conducts heat better than silver. It also possesses powerful antimicrobial properties, killing bacteria and preventing infections. These characteristics make silver irreplaceable in many modern technologies. The photovoltaic sector, meaning solar panels, consumed 197.6 million ounces of silver in 2024. Despite manufacturers' aggressive efforts to reduce silver content per panel through a process called thrifting, absolute demand continues rising because global solar installations are expanding so rapidly. The installations grew 76% in 2023, with another 34% growth in 2024. And here's the kicker. New high-efficiency solar panels actually use 20 to 40% more silver per unit than previous generations, offsetting thrifting efforts. Silver is the magic ingredient that makes these panels work efficiently. And as the world races to build renewable energy infrastructure, the appetite for silver shows no signs of slowing. Electric vehicles represent another massive new demand source that barely existed 15 years ago. A standard electric vehicle contains about 25 grams of silver in its components. Larger EVs might have 50 grams, but here's where it gets really interesting. Solid-state batteries, which represent the next generation of EV technology, could require a kilogram or more of silver per vehicle. If that technology becomes standard, we're talking about a 40 to 50 times increase in silver content per vehicle. The global automotive industry produces roughly 90 million vehicles per year. Do the math on what happens if even a fraction of those vehicles start requiring a kilogram of silver each. The medical sector relies on silver for wound dressings, catheters, and medical devices that prevent infections. Water purification systems use silver to destroy harmful bacteria. 5G infrastructure requires silver for its electronics. Artificial intelligence hardware needs silver for its high-performance computing components. Every smartphone contains a small amount of silver. Every computer contains silver. The entire modern technological civilization we've built is shot through with silver in ways that most people never think about. On top of the industrial demand, investment demand adds another dimension. Silver has served as money for 5,000 years of human civilization. When people lose faith in paper currencies or worry about economic instability, they traditionally turn to precious metals. Silver-backed exchange-traded products saw holdings increase approximately 18% by November of 2025. When you combine record industrial demand with renewed investment interest, you create conditions where the existing supply simply cannot keep pace. Now let's talk about what's happening to the physical metal that does exist, because this is where the story gets truly alarming. The London Bullion Market Association, which operates the world's primary wholesale precious metals market, reported silver vault holdings of 827 million ounces at the end of December 2024. That sounds like a lot until you realize it represented a dramatic decline from peak holdings above 1 billion ounces in 2021. Between early December 2024 and the end of February 2025 alone, London vaults saw withdrawals of 128.5 million ounces, a 15% drawdown, in just 3 months. But here's the really important part. Not all of this metal is actually available to markets. Approximately 551 million ounces of London silver backs unallocated ETF positions, leaving a free float of perhaps 276 million ounces. Industry insiders warn that much of this remaining inventory may be locked in long-term storage agreements held by owners who won't lend it, or sitting in forms or sizes that can't quickly be converted to meet immediate demand. The metal exists, but it's essentially frozen, unavailable for the market to access when needed. The situation at COMEX, the primary U.S. futures exchange, tells a similar story. Registered silver inventories, meaning metal specifically designated as available for delivery against futures contracts, stood at approximately 73 million ounces in early 2025. That's up from near 30 million ounce lows in summer 2023. But consider what's happening daily. Exchange for physical transactions, which convert COMEX futures into London spot contracts for immediate delivery, have been running at 3 to 5 million ounces per day. At that rate, you could drain the available inventory in a matter of weeks if the demand persists. Market analysts watching these inventory levels are using words like implosion and collapse. Some warn that the free float of silver available in London may be down to just tens of millions of ounces, possibly even single-digit millions. When you're running 3 to 5 million ounces per day of EFP transactions alone, not counting all the other demands on the physical market, it doesn't take sophisticated mathematics to see that something has to give. The premium structures in the market are already screaming distress. In October of 2025, COMEX silver futures traded nearly $1 per ounce higher than London spot prices. That's an unusual inversion that typically signals severe physical tightness. The premium to convert COMEX futures into physical silver through exchange for physical contracts spiked from near zero to over 80 cents per ounce in just 48 hours during periods of acute demand. When you see premiums expanding that rapidly, it means someone somewhere needs physical metal immediately and is willing to pay substantial premiums to get it. Against this backdrop of regulatory pressure, structural deficits, and collapsing inventories, the forecasts of $100 silver have migrated from fringe speculation to serious mainstream financial analysis. Major banks that would have laughed at such predictions 5 years ago are now putting triple-digit price targets in their official research reports. BNP Paribas issued predictions that silver could hit $100 by the end of 2026. Bank of America, in its 2026 outlook, forecasts a high of $65 per ounce and an average price over $56. Industry executives who have spent their entire careers in precious metals are making even bolder calls. The CEO of First Majestic Silver has maintained his forecast of triple-digit silver prices, arguing that you need prices at those levels just to motivate mining companies to invest in new production, given the risks involved. Another industry insider predicted prices between $200 and $400 per ounce before the current cycle completes. The global head of strategy at a major European bank told financial media that he would not be surprised to see silver well north of $100 in the not-too-distant future. When you examine the mathematics of the gold-to-silver ratio, these forecasts start looking less outlandish. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historical averages place this ratio between 60 to 1 and 75 to 1. During extreme market dislocations, it has ranged as wide as 100 to 1. As of late 2025, the ratio hovers around 85 to 1. If silver reaches $100 and the ratio stays at 85, that implies gold around $8,500 per ounce. Conversely, if gold reaches $5,000, a level many analysts consider likely over the next few years, and the ratio reverts to a historical average of 75 to 1, silver would trade around $67 per ounce. But here's what makes $100 silver more than just extrapolation from ratios. When you adjust the 1980 peak for inflation, Silver's all-time high of roughly $50 per ounce translates to approximately $150 to $200 in today's currency. By that measure, silver at $100 would still represent a significant discount to its inflation-adjusted historical peak. The difference between today and 1980 is crucial. That price spike resulted from deliberate market manipulation by the Hunt brothers attempting to corner the market. Today's potential move would be driven by fundamentally different forces: genuine industrial demand, investment flows during economic uncertainty, and structural changes to the banking system itself. The timeline matters enormously. With the United States implementing Basel III rules in July of 2025 and the United Kingdom following in January of 2027, the next 18 months represent a critical transition period. Major bullion banks must restructure their businesses during this window, unwinding paper positions they've maintained for decades. If this unwinding coincides with continued strong physical demand and the exhaustion of exchange inventories, you could see price movements that make the past year's rally look tame by comparison. Here's what keeps precious metals analysts up at night. If current deficit trends continue at approximately 150 to 200 million ounces annually, and visible exchange inventories keep declining at recent rates, the buffer of above-ground silver available to meet demand could effectively disappear within 12 to 24 months. At that point, prices would need to rise enough to either curtail demand significantly or stimulate substantial new supply. But remember that supply can't respond quickly because of the byproduct nature of most silver mining. And industrial demand can't easily disappear because silver is irreplaceable in many applications. When an unstoppable force meets an immovable object, something dramatic has to happen. In commodity markets, that something is usually a price spike that clears the market by making consumers reduce usage and bringing previously uneconomic supply online. The geopolitical dimension adds another layer of complexity and urgency: the U.S. Geological Survey designated silver as a critical mineral in 2024, recognizing its importance for national security applications including defense technologies, electronics, and renewable energy infrastructure. China implemented export controls on physical silver, effective January 1, 2025, joining similar restrictions on gallium, germanium, and graphite. When major producing or consuming nations start treating a commodity as strategically important enough to control its flow across borders, that's a signal that the stakes have changed. We're no longer just talking about an industrial commodity. We're talking about a material that nations view as critical to their economic and security interests. For American manufacturers relying on silver-intensive processes, particularly in solar energy, electronics, and medical devices, the combination of rising prices and potential supply disruptions represents a significant business risk. Some companies are implementing long-term supply agreements, trying to lock in metal at current prices before it rises further. Others are increasing inventory buffers, holding more silver on hand than they normally would. The most sophisticated are accelerating research into alternative materials or processes that use less silver, though the unique properties of silver make substitution difficult in many applications. The solar industry faces an especially acute dilemma. The world is trying to build massive renewable energy infrastructure to address climate change, and silver is absolutely essential to making solar panels work efficiently. Current technology pathways suggest the solar sector alone could consume 85 to 98% of global silver reserves by 2050. That's not a typo. If we keep building solar panels at the rate climate goals require, using current technology, we're on track to use up virtually all available silver within a quarter century. Something will have to give. Either the technology will have to change dramatically, the pace of solar build-out will slow, or silver prices will rise to levels that fundamentally change the economics of solar energy. But let's not sugarcoat the risks and uncertainties. Silver remains one of the most volatile commodities on the planet. Traders who work the COMEX pits jokingly referred to it as the widow maker because of its speculative nature and the leverage involved in futures contracts. The path from $60 to $100 or beyond will almost certainly include significant drawdowns, false breakouts, and extended consolidation periods that shake out impatient investors. When silver prices spike, economic forces kick in that weren't present at lower prices. Old silverware becomes economical to melt down. Industrial users work harder on substitution and thrifting. Investment sellers emerge to take profits. These forces create natural resistance to runaway price increases. A severe global economic recession could reduce industrial demand substantially, particularly in sectors like construction, automotive, and consumer electronics. Technological breakthroughs could enable dramatic reductions in silver content without sacrificing performance. Significantly higher interest rates increase the opportunity cost of holding non-yielding assets like silver, potentially dampening investment demand. At sufficiently high prices, previously uneconomic silver deposits could become viable, eventually bringing substantial new supply online, though the lead time for new mining projects typically spans 5 to 10 years. Yet when you step back and look at the full picture, the case for substantially higher silver prices rests on more than speculation. 5 consecutive years of supply deficits, totaling roughly 800 million ounces. Record industrial demand showing no signs of abating. Collapsing inventories at exchanges worldwide. Basel III forcing the unwinding of 300 to 1 paper leverage. Limited ability of mining supply to respond to price signals. Growing investment demand as economic uncertainty persists. These are not temporary factors that will resolve quickly. These are structural changes to how the silver market functions. What makes this moment extraordinary is the convergence of these forces within such a compressed time frame. Regulatory changes, inventory depletion, and structural supply deficits are all reaching critical points simultaneously over the next 18 months. The window that may be closing is not some magical opportunity that disappears overnight, but rather a confluence of factors creating conditions where silver could move substantially and perhaps explosively higher. Whether that move delivers $100 silver in 2026 or takes several more years remains uncertain. What seems increasingly clear is that the silver market is undergoing its most significant transformation since the United States abandoned the gold standard in 1971, and very few people understand the magnitude of what's coming.